Hey Brianne, and welcome back to the channel. Today, we're diving deep into a financial tool that is often misunderstood but incredibly powerful. The Health Savings Account, or HSA. You might have heard it called the ultimate retirement account, even better than a 401k or a Roth IRA. But what's the real story? And what's this triple tax threat I'm talking about? Stick around, because by the end of this video, you'll see the HSA in a whole new light. First, let's clear up that title. When I say triple tax threat, I'm not talking about a threat to you. I'm talking about a threat to the tax man. The HSA is one of the only accounts in existence that offers a triple tax advantage, and it's a beautiful thing. It is like a supercharged savings vehicle that combines the best features of both traditional and Roth retirement accounts. So, what are these three magical tax benefits? Let's break them down one by one. Benefit number 1. Your contributions are taxed. This is just like a traditional 401k or IRA. The money you put into your HSA for the year can be deducted from your taxable income. Let's say you're in the 22% tax bracket and you contribute the maximum amount for an individual. Right off the bat, you're saving a significant chunk of money on your tax bill for that year. It's an immediate, tangible benefit. You get to keep more of your hard-earned cash instead of sending it to the government. This deduction lowers your adjusted gross income, which can also help you qualify for other tax credits and deductions. It's a win. Benefit number 2. Your money grows tax-free. Once your money is in the HSA, you can invest it. Many people don't realize this, but an HSA isn't just a simple savings account. Most HSA providers offer a range of investment options, like mutual funds and ETFs, similar to what you'd find in a 401k. And here's the kicker. All the growth, all the dividends, all the capital gains your investments generate inside the HSA are completely tax-free. Over decades, this tax-free compounding can lead to explosive growth. Imagine your investments growing for 20 or 30 years without ever being touched by taxes. That is a massive advantage that can add tens or even hundreds of thousands of dollars to your account balance over time. And finally, benefit number 3, the one that completes the trifecta. Your withdrawals are tax-free, as long as they're used for qualified medical expenses. This is the Roth-like feature. You can use this money for a huge range of things. Dr. B's dental work, prescription glasses, surgeries, even things like acupuncture and chiropractic care. And you can use it now, next year, or 30 years from now in retirement. The money you pull out for these expenses comes out completely tax-free. No income tax, no capital gains tax. Nothing. So let's recap the triple tax threat. Tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. It's an unbeatable combination. Now, you might be thinking, this sounds great, but what's the catch? Well, there are a few rules. The main one is that to contribute to an HSA, you must be enrolled in a high-deductible health plan, or These are health insurance plans with, as the name suggests, a higher deductible than traditional plans, but they usually come with lower monthly premiums. So, you're trading a higher potential out-of-pocket cost for a lower fixed monthly cost and access to this incredible savings tool. For 2024, the IRS defines an HDHP as a plan with a minimum deductible of $1,600 for an individual or $3,200 for a family. There are also contribution limits. For 2024, you can contribute up to $4,150 for self-only coverage or $8,300 for family coverage. If you're age 55 or older, you can add an extra $1,000 as a catch-up contribution. It's important to note that these limits often increase each year to keep up with inflation, so always check the latest figures. Okay, so we've established that an HSA is fantastic for medical expenses, but here's where it transforms from a great healthcare account into a legendary retirement account. What happens to the money if you stay healthy and you need to spend it all on medical bills? This is the secret sauce. Once you turn 65, your HSA essentially becomes a traditional IRA. You can withdraw money for any reason you want: travel, hobbies, home renovations, you name it. If you use it for non-medical expenses, you'll pay ordinary income tax on the withdrawal, just like you would with a 401k or traditional IRA. But, and this is a huge but, you can still withdraw the money completely tax-free for qualified medical expenses at any time, even in retirement. Think about this. Retirees often face their largest medical bills later in life. Having a dedicated, tax-free bucket of money to cover those costs is a game. It protects your other retirement savings from being drained by healthcare needs. So, you have this incredibly flexible account. It's a tax-free health fund if you need it, and a tax-deferred retirement fund if you don't. Let's talk strategy. How do you maximize this amazing tool? The ultimate pro move is to pay for your current medical expenses out of pocket, if you can afford to, and let your HSA money stay invested and grow tax-free for the long haul. Keep all your receipts for those out-of-pocket medical expenses. You can reimburse yourself from your HSA for those expenses at any point in the future next year, 10 years from now, or even in retirement. Imagine this scenario. Over 20 years, you rack up $30,000 in out-of-pocket medical expenses, all while your HSA has been growing. Another key point to consider is portability. Your HSA is your account. It's not tied to your employer. If you change jobs, you take your HSA with you. You can roll it over to a new provider if you find one with better investment options or lower fees. This gives you complete control over your money. Now, what are the downsides or things to watch out for? The main one is the high deductible health plan requirement. An HDHP isn't right for everyone. If you or your family have significant, predictable medical needs, the high deductible might mean you pay more out of pocket than you would with a traditional, low deductible plan. You have to run the numbers and see what makes sense for your personal situation. Also, if you withdraw money for non-qualified expenses before age 65, ULL get hit with a double whammy. ULL pay income tax on the withdrawal, plus a 20% penalty. So, you really want to avoid touching it for anything other than medical bills until you hit that magic age of 65. Let's put it all together. The HSA is more than just a way to pay for doctor's visits. It's a strategic long-term investment vehicle. When you think about your retirement savings, you should consider the HSA right alongside your 401k. An IRA. Many financial experts even suggest a funding waterfall that looks something like this. First, contribute enough to your 401k to get the full employer match. That's free money you should never leave on the table. Second, max out your HSA contributions. The triple tax advantage is just too good to pass up. Third, go back and max out your 401k, and then a Roth IRA if you're eligible. By prioritizing the HSA after your 401k match, you're re-leveraging its unique tax benefits to build a powerful and flexible financial resource for both your health and your retirement. It acts as a safety net for healthcare shocks, while simultaneously building a nest egg for your golden years. It's the financial multi-tool you never knew you needed. So, is the HSA right for you? If you have access to a high-deductible health plan and you're looking for a way to lower your taxes today while saving for the future, the answer is a resounding yes. It's a powerful tool to take control of your healthcare costs and supercharge your retirement savings. The triple tax threat is a threat to high tax bills and a huge win for your financial future. I hope this breakdown helped you understand the incredible potential of the health savings account. It's one of the most powerful, yet underutilized, financial tools available today. Do your research. Check out your employer's benefits and see if an HSA can fit into your financial plan. That's all for today. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on personal finance and investing. Let me know in the comments if you use an HSA or if you have any questions. Thanks for watching, and I'll see you in the next video.